Hey guys, Jeff Beers here from the channel 40 Finance. Today I'm looking at the biggest stock losers of 2018. Let's see who's made the list. All right, so first on the board of stock losers for 2018 has to be General Electric. Anyone who follows this stock, anyone who works for GE has to be wildly concerned about the future of this company. What we see here in 2018, GE is down 56% year to date. So that's not the last 52 weeks. That's January 1 through now. For this study, I tried to look at large and mega cap stocks, names that we would recognize, to give you an idea of who the biggest losers were for 2018. So GE down 56%. Look, the pain really started in 2017 where they were running about $30. Then they dropped all the way to right around 15 entering 2018. And then from there it went from 15 to, $7.50 on the year. So rough ride for GE. They also eliminated their dividend this year. So it's turned into a speculative stock to some degree. And if you think that there's a win, there might be, but it's probably 5 to 7 years away. I know that they still have a solid aircraft engine department. I'm sure that there's other pieces in there that are still viable. It's going to take some time to reorganize from this one though. Next on the list is Western Digital Corporation, ticker symbol WDC. Western Digital makes a lot of flash drive, physical components that physical memory components, I guess is the best way to put them. If you want to have a cold storage for your computer, if you need portable storage to go from one laptop to the other and the cloud is not a solution for you, or you just want to have a physical copy for backup purposes, then Western Digital makes products that would be of interest to you. So the portable memory industry as a whole, I think, is a little rocky because the cloud is so popular, and the little USB sticks we all used to run around with, they're not as prevalent. I think there's still use for it, but Western Digital definitely needs to move more into an enterprise game where they're backing up, large sets of data in a physical capacity. When you take a look at the start of 2018, they were in that sort of $80 to $90 range, and they've since dropped 54% down to $37.90. So not a good year for Western Digital. And if you're an investor of Western Digital, you have to ask yourself, is this the end of the drop, or do I need to get out now before it goes worse? So a lot of analysis required there. And when you see drops like this, and you basically see Western Digital's business cycle, very odd behavior. So there's, the bullish case would be, well, what if we were in here and we rode out the storm, then we would have gotten up here. Will that roller coaster happen again? Hard to say. You'll have to study and see what their growth prospects are for 2019. All right, next on the list is a popular one with dividend investors, which is the Kraft Heinz company. This company went through some changes. Kraft used to be a separate stock and they've merged together, so the historical chart is not very long. However, you do see in 2018, they started in the $65 range, and now they're down to $45, which is a total loss, 42% year to date. This world of consumer food products is very interesting. And, we will naturally, as populations grow, we need more food. But it's really starting to shake out into a land where smaller brands are starting to make an impact, and the choices for consumers are expanding across the horizon. Makes it very difficult for big corporations like P&G, Heinz, all these companies to keep up with the fast-moving marketplace and expect to still get returns from the same ketchup bottle you've had for 100 years. There has to be, you know, things are changing fast. Companies like this don't change fast. The only benefit that they have is that if they're run well, they have a lot of cash that they can go buy some of these smaller brands and integrate them into the company. But that takes time. Buying growth is not always the best strategy, and you can take a look at the hundreds and thousands of acquisitions that you see in the tech space. Very rarely is it a one-to-one deal where you buy a company and you inherit the same amount of revenue over 3 to 5 years. Typically, growth stops and you're left with paying more than you bargained for, so to speak. So a lot of challenges ahead for Kraft Heinz. They are not the only ones that face these challenges. I think everybody who's in the sort of dinosaur consumer brands has a lot of thinking to do to turn their companies around. It's going to take strong leadership and a solid business plan to take Heinz from $45 anywhere up to the former peak of $100. It's just going to take some acquisitions and some smart marketing. We'll have to see if they're capable of that. Next on our list is Schlumberger Limited, which sounds like a name you would call somebody at school if you're picking on them. But what you see with Schlumberger this year, they're down 43%. They're in the oil and gas and equipment services. We know that oil and gas prices have tumbled quite a bit, so the premiums on people who are selling oil and gas, or the distribution systems in this case, have also taken a hit. So with Schlumberger, it looks like the company kind of ebbs and flows with gas prices, as you see through here. They did take a dip from from about $68 down to $37.81 this year. Without knowing a whole lot about this sector, my guess is that they're having to do some pullbacks with the oil and gas prices. There's oversaturation of oil in the marketplace, so a lot of people who are producing oil, producing energy, are taking a hit right now. However, it's pretty safe to assume there'll be some ebb and flow in this market. Will it be in 2019? Will it be in 2020? I'm not sure. This is not a sector that I invest in. However, if you are familiar with it, then this could very well be the opportunity you're waiting for. So more analysis required, but those of you who follow oil and gas, Schlumberger's been around for a long time. The S&P 500 company might be worth digging into. Okay, last on our list today is FedEx Corporation, and this one just got hammered as they issued some concerns about growth. They talked about concerns with the China situation and tariffs and which way the trade market is going to go, because that obviously impacts shipping. And with FedEx, at least the little bit that I know about it and the little bit I can dream about the shipping industry, this is one where you have to start thinking about maybe it's a time to buy, right? Are deliveries going to stop? Is e-commerce going to stop? Is the trade war an infinite one? I personally think no. When you see a stock go from a high of 250 or so in 2018 all the way down to 164, I personally can see this as a company I would invest in from a logistics standpoint, only because I don't have a lot of representation in that area. And I'm also, remember, I'm a big e-commerce purveyor. Technology, e-commerce, those all play into results for FedEx. So it is one to look at. For the year, they're going to end somewhere in the neighborhood of minus 35%. But is FedEx going out of business? Not even close, okay? Obviously, they have competition in UPS. Postal Service is not a competitor. So I think here we're looking at a company that has a pretty stable footing on what they do. It's just in a downturn right now. So it'd be a great opportunity, if you can afford it, to maybe pick up some shares of FedEx for the long term. So that's it, guys. That's my list of 2018 stock losers. There's others in there. I just tried to pick some names that everyone would know. My name's Jeff Beers. This is 40 Finance. Please subscribe and share these videos with your friends if you enjoy them. I'll see you on the next video.